Good morning, everyone. I wanted to give a few more reasons for yesterday's major stock market sell-off. It was the Dow Jones 10th consecutive losing day. That's its longest losing streak since 1974. Well, when Jerome Powell and the Federal Reserve made their speech yesterday, although the market and a lot of investors kind of anticipated that there'll be less interest rate cuts next year, which Jerome Powell confirmed, when that was confirmed, the reality of that happening, it kind of spooked investors. Jerome Powell recently, before this meeting, was more on the dovish side, and the fact that he's reiterating that the economy is very strong, inflation's a little bit sticky, and the labor market's at a good place. That kind of spooked investors because investors want more rate cuts. They want more liquidity. They want more money pumping into the economy. And if you're slowing down the pace of that, investors are going to have a revolt. This happened back in 2013 when the Fed was slowing down, their pace of rate cuts and what was known as a taper tantrum. So that kind of what happened yesterday. I think it's a little bit of an overreaction. We're seeing a recovery today, although the recovery is off its highs today. Who knows how the market will eventually close today? I thought yesterday was certainly an overreaction, in my opinion. Look, the economy is still very strong. We're in a decent place. But the market didn't like. We're going to see less rate cuts than initially anticipated. As I said, we want to see more rate cuts because that's good for the economy. However, I think what Jerome Powell did and the Federal Reserve with saying less rate cuts is better for the economy long term. Look, yes, Jerome Powell made some contradictory statements that inflation is still hot, but it's improving. Labor market still strong, but there's some weaknesses. He made some contradictory statements, but he also doesn't know the full ramifications of what Trump's policies will be, especially with tariffs, deregulation, and tax cuts, in terms of how strong that'll make the economy or not, and how inflationary that'll be. There's a lot of question marks, which is why I don't think the Federal Reserve wants to overly cut interest rates right now. So I think that's a prudent, good strategy. It's good for the long term. And then on top of that, as this was happening yesterday, and as I said, a little bit of an overreaction, in my opinion, we had news reports that Trump was wanted to strike down the kind of this spending deal that was a bipartisan spending deal that was agreed to with Speaker Johnson. And regardless of where you fall on that debate, I'm sure there's a lot of spending there that could be wasteful and inefficient. The markets don't like when if a spending bill necessarily isn't agreed upon. They want to see Washington work well. They want to see, they want to see a spending bill passed before, any debt limit. So, that perhaps could have spooked the market. But at the end of the day, there could be some wasteful spending in that bill. On X, there was some of the wasteful spending examples were being advertised. So, but at the same time, we want to see an agreement. We don't want to hit that debt ceiling. We don't want a government shutdown. So hopefully a revised agreement could be reached soon. That could have been another reason for yesterday's sell-off. But as I said, I think yesterday's sell-off was an overreaction and a viable dip, in my opinion. And I expected the market next year to continue its trend. Look, I mean, Jerome Powell's dot plot won't stand in the way of the tailwinds of artificial intelligence, in my opinion.